So today I'm going to share how Travis and I became owners of a $12 million, 120-room hotel without doing any of the work to find, renovate, or operate this hotel. It's the same way people are able to buy multi-million dollar businesses, properties, and other assets. They go through pooled investments, and it's usually through an investment vehicle called private equity. You've probably heard the term private equity, but never fully understood how it works or how to tap into it. I didn't either, and now Travis and I have become LPs and have become GPs of our own real estate funds. We are doing all these alternative investments because we want our families to have access to the true wealth generators. We're the first in our families to venture into a lot of these exclusive spaces, and we see the opportunities that they offer to create huge value and set up wealth that we've never been able to tap into before. So we're going to get into it and see what actually goes on inside a private equity fund. I'll explain how these funds are structured, how the fees and returns work, and highlight some of the terms that you need to look out for as an investor. I'm going to use a lot of examples from real estate because that's what I know and love, but the private equity fund structure is common for all types of assets and businesses. So welcome. If you're new here, I'm Maiki. I'm the globe-trotting half of Coupled Investments, which I run with my husband and partner, Travis. So yes, I've done things like convince Travis to pick up our lives and move to Puerto Rico, where we are now. All right, let's break it down step by step. This is where we're going to map out exactly how these private equity funds operate. Most funds are usually set up as either a limited partnership or a limited liability company. Let's break down these structures. In a limited partnership, there are at least two key entities you need to understand. The first is the general partner, or the GP, which is the fund manager. The second is the limited partnership, which is made up of the passive investor class, also called the limited partners. The GP is responsible for managing the fund. Your job as a GP is to source opportunities, make deals, and manage investments. The LP is a separate entity. You can think of it as a pool of money contributed by your investors. When you pitch an idea to potential investors and they like it, they can become your LPs. They commit their capital to the limited partnership, and that's the pool of money you, as the GP, will use to make investments. When these investments generate profits, the returns flow back to the LP. The limited partnership is essentially a pass-through entity, meaning profits get distributed to the investors and the GP. This is also where the GP makes money, by taking a share of the profits. If you hear folks talk about carried interest, they're referring to this share of profits that goes to the GP for their services. So we see the benefits of being a limited partner, especially in opportunities that help us diversify broadly. For example, I found an opportunity to invest in a 120-room hotel, as I mentioned, and we decided to join the deal as LPs, which means we put in the money to help make the deal happen. Now, as LPs in this operating hotel business, we can get our respective share of cash flow during the holding period, and we get equity, which is like any cash after paying off debt and expenses. So we get that equity from the sale of the property as well. Instead of a limited partnership, you can also set up a fund using a limited liability company. This is what we did with our own fund based on the advice from our lawyers and advisors who pointed out the benefits and flexibility of the structure. In the LLC structure, the roles are similar to those in a limited partnership. So we have the managing members in the structure, which is similar to the GP. These are the decision makers. They choose the investments, they manage the assets, and they handle any issues that come up. The members are similar to the LPs. These are the passive investors who contribute capital to the LLC. They receive ownership shares based on how much they invest, just like LPs in a limited partnership. One key aspect of these private equity funds, especially in real estate, is how they handle individual investments. Rather than buying assets directly in the fund, these funds often set up special purpose entities, SPEs, or single purpose ventures, whatever you want to call it, for each property or project. This means that each property is technically its own little company that's owned by the fund, but separate from the other properties in the fund's portfolio. This setup has a lot of big benefits, especially when it comes to risk. For instance, if one property faces issues like needing unexpected repairs or dealing with legal troubles, that liability doesn't affect the other properties in the fund. It's all contained within that single purpose entity. In our case, for example, since we often do value add construction, keeping each project separate helps protect both the investors and the fund overall. So we talked about the benefits of a fund for LPs. Why would someone want to start a private equity fund as a GP? One reason is that it allows us to work with more people and raise the funds needed to take on larger deals. Starting the fund also lets us bring pretty unique opportunities to our network that they might not otherwise have access to at all. Some people are interested in real estate, but they don't want to be hands-on dealing with acquisitions, financing, or property management either. So as GPs, we can do the whole process to find and manage the investments end to end. We're creating that value for the LPs by giving them access to these unique investment opportunities without any of the hassle. Now, before we get into how profits are shared, I would love it if you guys could subscribe to our channel if you want more resources like this, and also check out our newsletter using the link in the description. Now, let's talk about how GPs are compensated for what they are bringing to the investment group. In private equity, fees are a way for GPs to cover the costs of finding and managing investments. It's actually about keeping the fund running smoothly and paying for the work involved in making each deal happen. Here's a breakdown of common fees you might see, especially in real estate funds. There's an acquisition fee that's usually between 1 to 5% of the purchase price, and it's meant to cover the work that the GP does to find and evaluate each property or business. This is going to include things like due diligence on the properties, negotiating with sellers and securing financing, and closing the deal. There's also usually an asset management fee, which is usually around 2% of the assets under management, and it's a flat fee paid to the GP for actively managing the property or businesses on behalf of the fund. This fee is paid regardless of how well the fund performs, and it ensures the management team can keep working even before the property generates cash flow. Again, these fees are usually meant to give sufficient resources to the management team so that it can keep working until the property actually begins to cash flow and there are profits that can be shared between the manager and the LPs. After the fees, the profits are usually split among the LPs on a pro rata basis, meaning they get a percentage of the profits according to how much they invested. For example, if an investor put in 5% of the total money in the funds, they get 5% of the profits. There's also often a performance incentive for the GPs. So if the fund does well, the GP gets an additional share of the profits, which can be a motivator for them to maximize returns, right? A common structure, by the way, that you might see is, an 8% preferred return to LPs, meaning that they get the first 8% of profits before the GP receives anything. And then after that, any remaining profits are going to be split with the GPs and LPs. For example, you could have a 70-30 split with 70% going to the LPs and 30% going to the GP. This kind of milestone-based profit sharing setup helps align everyone's interests since the GP benefits from strong performance as well as the LPs. When you invest in a private equity fund, all of these details are governed by a couple of really important documents. These are going to include your limited partnership agreement, the LPA, or in the case of LLCs, it's an operating agreement. And these agreements describe the rights and the duties of the GPs and LPs. It basically serves as the contract between investors and managers. There's also the private placement memorandum, the PPM, and this is like your business plan for the fund. It includes all of the info on the investment strategy, the projected returns, risk, disclosures, and a lot of other key information. So these are the primary documents, and they're going to outline everything: the fees, terms, investment guidelines. And this is all meant to give, both the managers and the passive investors a clear roadmap and a clear description of the roles and responsibilities. So read these documents. You're going to find a lot of important information and some key terms that you'll need to know and understand. One that you should get really excited about is excess distributable cash. This is actually the money left over after paying expenses and fees, and this is the pot of money that investors are paid out of. You can also think of it as free cash flow. And as we know, free cash flow is how wealth is generated. So if you're considering starting a fund, it's really important, needless to say, to work with a lawyer familiar with the Securities and Exchange Commission regulations. Because when you're selling passive interest in a fund, you're actually selling securities, which are regulated by the Federal Securities and Exchange Commission or state securities agencies, and sometimes both. Most funds are going to operate under Form D, Regulation D, which is specifically where you find the 506B or 506C regulations, which are the frameworks for legally selling private securities. All right, that's all for now on private equity fund structures for real estate. Whether you're interested in becoming a passive investor or if you want to dive into the GP side of things, hopefully this helped you understand the basics. All right, before I see you in the next video, remember to subscribe to our channel and check out our newsletter using in the description for more resources. Until next time.